Hello and welcome to Unleashed, the show that explores how to thrive as an independent professional. I'm your host, Will Bachman, and I'm here today with Gabe Nelson, who is a solopreneur, a financial advisor. He's also the author of the Solopreneur Money Manifesto. He's got a podcast as well. Gabe, welcome to the show.
Will, thank you for having me on. I'm excited to be here.
And let's give a promo for your podcast as well. Remind me of the name of your show.
The podcast is called Solopreneur Money, and you can find it everywhere.
Fantastic. So pause right now. Go ahead and sign up, subscribe to Gabe's show. So Gabe, tell me a little bit about your practice. You focus on serving solopreneurs as an advisor. Tell us about the services, the range of services that you provide.
Well, my services I provide is the best way I can explain it. It would be overall financial and business planning advice. Some people might call it wealth management. I just call it overall business and financial planning advice, where we go through and discuss everything from your cash flow planning to your retirement planning to all of the legal structures that you should have in place, to tax reduction, to how to retire on time in the way you want to, all the way to how to run your business better. I've been doing this for nearly 27 years, and the best way I can explain it is I've made a ton of mistakes. And so I've got a lot of wisdom to share with other solopreneurs on how we can run our businesses better as well.
Okay. And what are you said you serve solopreneurs. What are give me sort of the typical types of solopreneurs that you're working with? I mean, there's a broad range. Are we talking about like writers and artists, or consultants, or just what sorts of what's your typical client?
Typical client would be in a few different areas. One would be coaches and consultants. I love working with them because they're very similar to financial advisors in the way they operate and the way they work with people. Creatives. I've got a client that I work with who's a very successful creative in the kind of copywriting and marketing world. And then I've got another client that has just come on that is an online business manager, which is really kind of a neat thing. She operates overseas, lives overseas, but is a U.S. citizen and has contractors all over the country and all over the world supporting her clients, which is pretty neat.
Cool. So help me understand, in the world of financial advisors, could you just sort of break down the different, almost like a taxonomy of the different services that someone might offer? Like, it seems that there's one piece of it is perhaps, so let me give my kind of non-informed view. It sounds like there's one piece that's more planning and structuring things. So thinking about, okay, how much are you earning? And, we want to put so much into, like this insurance policy, or, this kind of retirement fund, sort of structuring things and thinking about you're going to have so much for college. And then there's like a different type of activity, which is more specifically like managing your actual assets, so helping you figure out, okay, which specific mutual fund do you want to invest in? And maybe there's some additional distinctions beyond there. So if you would think about the menu or the taxonomy of the different services that someone might get from a financial advisor, could you walk us through those?
Yeah, definitely. And that's the interesting thing about our industry, the financial advisory industry, is everybody operates just a little bit differently. And that's the beautiful thing, but it's also hard for the consumer to go, what am I really getting here? So it spans everything from someone who does financial planning, but might only, what I would say, sell insurance. They might create a financial plan for you, but they might be going down the road of helping you get the right amount of insurance, to what I would call a holistic financial planner that comes into place, or a holistic financial advisor that comes into place and creates an understanding or a plan based of understanding where their goals and objectives of where they're trying to go, and creates a plan for their client to follow that does include cash flow planning, college planning, insurance planning, tax planning, legal planning, retirement planning, all of that. And then some people will just create the plan, charge you a fee to create the plan, and then allow you to go implement it yourself, or hire somebody else to help you implement it. Um, I operate in the realm of creating the plan, understanding where the goals and the relationships and everything that we're trying to go with, and then how to put that plan in place and then help to implement that in place. Such as, and I don't do insurance anymore. I used to do insurance. I refer that out, but then making sure that we are putting the plans in place, opening up the college funds and building those up, designing the retirement plan to meet what they're trying to achieve through the different options that are out there, and then helping make sure they get the right amount of money into the plan, and then choosing the investments and managing the investments and the whole piece. There are other advisors out there that do no planning. They, for lack of any other way to put it, and this is not a bad thing, but they'll take your money and invest it. And so if you come to them and say, we've got this $1 million, we really don't know what to do with it. What should we do? There are financial advisors that are out there that will put an investment plan in place, and that's it. They won't focus on the remaining planning and advisory. But you're seeing a big change in our industry currently and over the next few years, where a lot of those advisors are doing a lot more planning that didn't used to. And I think in terms of like the wirehouses, the big monster investment banks historically haven't done a ton of what I would call planning. But they're starting to move more into that as well, because it's such a valuable piece for the clients of that planning.
What are the wirehouses? Which does those include?
The wirehouses are the Merrill Lynches of the world, the Wall Street firms that you think of. The Merrill Lynch is part of Bank of America, the Morgan Stanley, the Goldman Sachs. Those types of big monster investment banks is what we would call the wirehouses in my industry.
Okay. So for a listener of the show who's, smart, perhaps has an MBA, as a management consultant, let's say, but hasn't ever created a financial plan or worked with an advisor to create a financial plan, walk us through what that would include. So what you go through the process, you get the deliverable at the end. What does the financial plan look like?
Every financial plan that I create looks just a little bit different, and because it's basically tailored to that client. But let's kind of walk through the basics of a financial plan. One, I keep it very, very simple. I try to get my financial plans on 1 to 2 pages if I can. The reason being is the days of the 78-page financial plan with all the projections and everything in there basically get set on the bookshelf and never get looked at again by the client. I create a very simple, easy bullet point financial plan that says, here's what we're going to do regarding your cash flow. Here's what we're going to do regarding your emergency savings. Here's what we're going to do regarding your insurance planning, or here's what you need to do. Tax planning, here's what needs to happen. Retirement planning, here's what needs to happen. And so I keep it very simple and go through everything from cash flow all the way through to estate, and then what I would call legal planning. It might be you need to go get a will. I mean, it's amazing how many people out there do not have a will in place, and might need to change your business from a sole proprietorship to an S corp. Or you might go down the road of an LLC, or might be an LLC, and then you might need to consider filing as an S corporation. And so it encompasses everything from cash flow all the way down to what I would say the legal and estate planning piece of the puzzle that we touch on every piece.
Okay. So you mentioned a couple times insurance planning. I'm assuming you're talking about life insurance. Some advice that I've received is just basically most people should just get plain vanilla term life insurance. Are you talking about life insurance when you say insurance planning?
I'm talking about all insurance, not just life insurance. I agree with you. I'm a bigger fan of plain vanilla term life insurance. Just get as much coverage as you can. That's my philosophy. There are places for those permanent types of life insurance out there, but I don't think that's the solution for everything. But I'm also talking about disability income insurance. If we're talking about solopreneurs, they don't have a benefit package that has disability income in place to protect them if they lose the ability to continue to produce an income because of a disabling event. I also dig into their health insurance program, making sure that they're taking advantage of the health savings accounts if they have them available to them, so that they can take advantage of what I call the triple tax benefits of health savings accounts.
Yeah.
So when
Yeah.
I say insurance planning, I don't mean just life insurance. I mean life insurance, disability insurance, health insurance, and even touch on, especially for solopreneurs, do they have some business liability insurance in place? Do they have some things to protect them in case something goes wrong? Um, or if their house burns down and all their computer equipment is fried.
On the health savings account, that's come up on the show once before. We had an episode where we talked about that a little bit, and what I heard from another guest was basically you should, as an independent professional, you should get a health savings account, and you should max out your contributions, but don't spend the money on healthcare now. You get one of these health savings accounts where you can invest it in like a mutual fund, and then you should let that grow over time, and then you can use that because it grows tax-free, right? You put it in pre-tax, and then it grows tax-free. You can take it out without paying taxes as long as you use it on health-related expenses when you're whatever over 65 or something. Is that what you're referring to?
Yeah, definitely.
Yeah. So that actually changed my behavior. I used to just use it for healthcare expenses, but I found an account where you can invest it in basically Vanguard mutual funds. So that's what I did. Just max it out, and it's sort of like an IRA, but even better because when you take the money out, it's tax free as well.
Yeah.
In terms of disability income, we did one episode on that. When I researched it, it seemed, at least for my situation, the short-term disability insurance didn't make a lot of sense, but I did end up getting a long-term disability policy. The short-term, it just, like the cost of it versus the what I'd get back in disability payments, it didn't make sense. What's your typical take on disability insurance, and like how much to get for a solopreneur, and short term versus long term? And there's also variables about like when it kicks in and so forth.
Yeah. Short-term disability, I agree with you. I think that you as a solopreneur can cover that with an emergency savings account and do a good job of building that up. The costs in relation to the benefits aren't quite as great. Long-term disability insurance, now that's a different game. Long-term disability insurance is if you are unable to continually produce an income doing what you do, and I'll get into a few more details on that. But the idea of disability income insurance to protect you if you can't continue to produce an income is one of those things that can, for lack of a put it, can totally derail your whole financial plan. So long-term disability income insurance, there's a few things I always tell people is look for own occupation definition of disability. Own occupation definition of disability means if you are currently a consultant or a coach or running your own business in whatever capacity that might be as a solopreneur, and you become disabled and cannot continue to work in that capacity, but you could go do something else with an own occupation definition of disability, you not only can get the benefits from the contract, but you can also continue to make an income elsewhere, which means you can kind of double dip a little bit. That's the one thing I always tell people to look for is the own occupation definition of disability. The next thing that I always tell people is start to think about, okay, what is your emergency savings position to allow yourself to basically kind of self-insure the first 3 months, 6 months, or 1 year of time until that policy kicks in. That's called the elimination period. And so the elimination period is kind of like your deductible with your car insurance. It's like, what do you got to pay first before the insurance company is going to pay the rest to fix your car? And so are you going to self-insure the first 3 months, the 6 months, or 12 months? The longer the self-insurance period or the elimination period, the cheaper the premium is going to be. And so it's kind of like having a deductible on your car insurance. You go from $100 deductible to $1,000 deductible, the price is going to be less on a monthly basis. And so then the next piece of the puzzle that I tell people to make sure that they're digging into and looking into is then what is the benefit period that you have available to you? And the benefit period is how long is that policy going to pay? Are you going to have it pay till 5 years? Or are you going to have that policy pay till age 65 or 67? That's the other piece that you want to make sure that you dig into. I'm a big fan of 6 months of a elimination period, and then having that own occupation definition of disability, and then having that policy pay benefits if you do have a disabling event, realistically probably till 67 years of age, depending upon your own goals and objectives of when you want to retire. And so that then encompasses what is going to be necessary in a disability income insurance policy. But the big thing I always tell people is make sure that you have been in business for a bit, or if you're making a transition, try to see if your disability income insurance policy is portable from your prior job making the change. Because if it's not, and you want to get disability income coverage, most insurance companies are going to want to see 2 years tax returns of you being self-employed, so that you don't have that moral hazard of, oh, well, I can't do this anymore. I'm not being successful. I can't do this anymore. Maybe I can get the insurance company to pay my premiums by having some quote unquote disabling event. And I'm not making light of a disabling event. I'm just saying the insurance companies aren't going to give you much love until you've been in business for 2 years or longer.
Mm-hmm. Okay.
Mm-hmm.
So let's see. We talked about HSA. We talked about life insurance a little bit, and disability insurance. What are some of your other most common recommendations? So when your typical client comes in and you've done the plan, what are some of the most common recommendations that you're providing?
Most common recommendations, and not in any particular order, but generally we need to build up our emergency savings fund. We generally need to get that taken care of. Most people don't have enough cash sitting around to protect them if something happens.
How much do you recommend?
I recommend 6 months for solopreneurs. I mean, I will hang around 3 to 6 months, but I like 6 months just to allow them to weather things happening. I mean, we just went through a pandemic. We're not quite out of it yet, but we're getting close. And I mean, there's some people who their business is shut down for 3 to 6 months immediately. So emergency reserve fund is the first piece. The second piece that I generally see that needs to be done is solopreneurs need to start building their retirement. They need to start moving forward with that. They might have something sitting at a prior job or whatever it might be, but a lot of times that gets kind of pushed aside as we're building our business and we're growing our lives and we're reinvesting in our business and we're traveling and we're doing the things. Sometimes we forget to go get that retirement plan put into place. And that's where I get really excited. I get excited talking about the different types of plans that are out there and then designing the plans to allow them to retire on their terms and start to be able to do it how they want to do it, and then start to allow them to put as much money in as they'd like, help reduce their tax bills, help to plan for that, is usually where we go. And a lot of times we have got to hound people to go get their wills done. I said it earlier, it's amazing how many people do not have their wills in place that need to be taken care of. The other thing that has a tendency to be in place is we got to go work on paying off debt. There's a lot of people that are sitting out there with a lot of debt that we got to go clean up. And so those are the things that I see most of the time that we have to work on a regular basis.
Yeah. Let's talk about that retirement piece a little bit. So, one common vehicle would be an SEP IRA. Talk to me about that a little bit, and talk to me about some of the other vehicles that you work with clients on.
Sep Ira. Sep IRA is a fantastic retirement account, especially for solopreneurs. But, and the reason I say but, is it has a few limitations in it. When you start doing tax planning and start doing income planning with how you pay yourself. The Sep IRA, the limit you can go up to is 25% of your bottom line. I always tell people, stay within 20% to be safe. The CPAs will always then come back with the exact number that we should be doing, but I usually play around the 20% that you can generally do in the form of your retirement account. Well, a Sep IRA works like this. Let's just say you had a $100,000 bottom line, and you are a sole proprietor, which means your bottom line is then your taxable income. 20% of that, for simple math, would be $20,000 that you could put into a Sep IRA, and then that money can be invested in mutual funds, ETFs, or whatever is your stocks, bonds, whatever you're going to use. And then that money grows tax deferred and then comes out when you go to retire. You'll pay ordinary income taxes on it when that time comes, as long as you're 59 and a half years of age or older. The $20,000 in this example is pre-tax. It's bottom line. It's top of the line, kind of comes off of your profit of the business. So instead of paying taxes on 100,000, you're going to pay taxes on 80,000 for this example. So that's a Sep IRA. Some of my solopreneurs will go down the road of a simple IRA. Not as many as we use SEPs, or the next one that I'll talk about, which would be a solo 401k. But a simple IRA is basically taking the idea of a 401k and bringing it down to a small business, where you can put up to, I think it's $14,000 you can put in this year if you're under 50 years of age. You then can have a catch-up contribution of another $3,000 to $4,000. I'd have to check the rules. Those numbers change every year, so that allows you to put, kind of like if you were still working at a job, it's kind of like a 401k contribution. You choose how much you're going to put in. It helps to reduce your taxable income. And then generally your simple IRA has anywhere from a 1%, 2%, or a 3% match that you would use your corporate checkbook, your business checkbook, to match for your salary or your bottom line. 3% of that would go in, so that you're doing salary deferrals plus company match into a retirement plan for yourself. The one I love to use for solopreneurs is the solo 401k. It takes the idea of a big business 401k and brings it down to a solopreneur, where you now have the ability, as long as your income can support it, you have the ability to get that maxed out all the way up to $60,000, $70,000 per year of contributions to your retirement account, depending upon how old you are and if you're doing catch-ups, etc. But the solo 401k allows a solopreneur to defer up to $20,500 of their own quote-unquote salary, whether that's traditional 401k or Roth 401k. You can do either one. And then you can come back in and do a catch-up contribution of another $6,500. So someone's 50 years of age or older in the 2022 year, they could put $27,000 into their solo 401k, whether that's traditional or Roth can be decided. The benefit of the traditional is you get tax deduction today. The money grows tax deferred, and you pay taxes at whatever rate you take it out at retirement. The benefit of the Roth is the same as a Roth IRA, only thing with a lot more contribution amounts that you can put in and no income limitations. The Roth can go in after taxes, so you don't get a tax deduction for funding it. It grows tax deferred. And when you go to take it out at retirement, 59 years of age, 59 and a half years of age or older, it is tax free at that time. And then you have the ability to do what's called a profit sharing contribution inside of the solo 401k, where you can go up to 25% of your W-2 or your bottom line, depending upon how you're paying yourself. So we can use the same example. Let's say you're 50 years of age or older, and you have a $100,000 W-2 or bottom line, and you deferred $27,000 to the solo 401k, and let's just use traditional 401k as the example. You then can come in and do another 25% profit sharing plan, which also reduces your tax bill because it's coming as a tax deductible expense from your business. So 25%, 25 grand plus another 27,000, you just put $52,000 that year away into a retirement account that then allows you to then grow that for retirement so that you can retire on your own terms. Now, conversation needs to be had. So do you need that much tax deduction? Do you need to go with some Roth? That all comes into the planning piece. But that is that's kind of my favorite place to go, because it allows the solopreneurs that are doing well build for retirement, but also reduce their tax bill, because no one really likes to pay their tax bills.
So can someone do the solo 401k and the Sep IRA?
No, you cannot. No, and you wouldn't need to. And the reason you wouldn't need to is the Sep IRA is just technically really the profit sharing portion of the solo 401k. So the Sep is just really, like I said, it's the profit sharing piece. And so 20 to 25% comes out of the corporate checkbook as your contribution to your retirement plan.
Okay. So for someone who's at a higher bottom line, let's say someone is let's do it like well above the max for a Sep IRA. So a Sep IRA, I think that the maximum you can put in is like 58,000, something like that. 25% of that would be obviously be 4 times 60, 240, something like that. Bottom line. Let's say someone was making $500,000. So with the Sep IRA, they're limited because they can only put out $58,000, pre-tax, right? Even though they're making $500,000, they're limited by the 25, not by the 25%, but by the cap. With the 401k, the simple 401k, how much could someone put away into that if they're making $500,000? Bottom line.
Well, the IRS sets the limits, and so the Sep IRA and the solo 401k contribution limits are going to be very similar. Okay. They're going to be about the same each and every year, but you have the ability to, with a solo 401k, you then can layer in what's called a defined benefit plan. And a defined benefit plan takes the old school way of our grandparents who used to have pensions, and some of our parents might have pensions. My dad actually does. Takes the idea of you're building your own pension. So let's take the $500,000 bottom line person. And let's just say that $500,000 bottom line person is 50 years of age, for example. That person could do the salary deferral of, $27,000. They then would elect a certain amount of profit sharing dependent upon how much they wanted to put into their defined benefit plan. For example, a 50-year-old person could adopt a defined benefit plan and put easily $100,000 into a defined benefit plan. So without adding any profit sharing contribution, that person was able to put $127,000 away for retirement. And if they're doing that, they're probably planning to do it all pre-tax, which means at $500,000, let's just use simple math, 30% tax bracket, you put $127,000 in, that's saving you, $30,000, $40,000 in taxes for the year.
Okay. That's very helpful. Now, you mentioned salary deferral a couple times. If someone has a plain vanilla LLC, then they're not really getting a salary, right? It's just profit, the bottom line. They just distribute it to themselves. Are you talking about sort of assuming that they have an S corp or they're paying a salary? Talk about that a little bit.
Yeah. The thing a lot of solopreneurs will do is they'll start to notice the complexities build as they start to become more successful. And then what happens is they start getting a little upset about the fact that they're paying so much in taxes, and they start looking to their CPA and sometimes their advisor for solutions. And that's where a lot of people will switch over to um, basically they might keep their LLC in place. Usually they do. They just start to file taxes as an S corp. And when you file taxes as an S corp, you then have to start paying yourself a salary, which means you're going to issue yourself a W-2. You're going to pay some withholding. You're going to pay your Fed and your FICA taxes. You're going to pay those taxes like payroll taxes as if you were still working somewhere else. But that's where that salary comes in. And a lot of my clients, we work towards that, or we move them there because it helps start to make a lot more sense tax-wise for them to go down that road.
Oh, and how does that help? Like, can you give us a theoretical example? Like, walk through the numbers. If someone is making, I don't know, we can use their same $500,000 a year example. If they're
Mhm.
starting with an LLC, they're making $500,000 after all their expenses. Okay, so their profit's $500,000, full stop. And if they structured it as an S corp and paid themselves a salary, how would their taxes change?
Well, first of all, anybody that's in that boat is paying self-employment taxes. And so yeah, that's usually the tax that surprises solopreneurs is the self-employment taxes. When you work somewhere else, they withheld 7.65% out of your paycheck. They then had to match 7.65%. So there's your 15.3%. So you're going to have self-employment taxes up to a certain level on your income. I believe that's going to be right up to the Social Security max, wage-based max, which is in the 140. I think it's 148,000 this year. So you're going to have self-employment taxes up to that number. And that you don't really get rid of unless you change the way your salary is in your W-2 range. But you basically have self-employment taxes, and then you also have ordinary income taxes on your bottom line. And so that $500,000 is going to put you in that 30% tax bracket. So you got 30% tax bracket on your $500,000, which is, what is that going to be? 150 grand? That seems a little high. No, that would be $150,000, which is ridiculous. And then you've got your self-employment taxes up to, let's say, the Social Security wage base max. Well, there's another chunk of change that's going to be there. A lot of times what we'll see is we will see solopreneurs go and move to an S corporation. They leave their LLC in place. They change to an S corporation, and they pay themselves a salary. And sometimes they'll pay that salary up to the Social Security wage base max, and that limits their self-employment taxes. But sometimes we'll even see them go lower. They might pay themselves $100,000 in salary, and they take a distribution out for some of the other, and that allows them to reduce the tax bill from that full bottom line on their income.
So, like, typically, I'm sure it varies a lot by state and the specific circumstances, but like order of magnitude, if someone is making $500,000 just for round numbers, and they switch from LLC to S corp, like how much might they typically save in taxes?
5 to 10 grand, probably pretty easily.
Okay, all right.
Mm-hmm. It's worth it.
So okay, so that's not like earth-shattering numbers, but probably worth paying attention to and going through the hassle of figuring it all out with your accountant.
Mm-hmm.
What are some of the, so we talked about, let's see, we talked about in insurance, we talked about HSAs, talked about retirement, and you talked about emergency savings and disability. Any other tips that you have? Like, we didn't really get into college savings. We didn't talk about maybe just I mean, anything else that people should be thinking about? What are the kind of common recommendations that would end up in your financial plan?
Well, the thing we didn't talk about is we didn't talk about the estate planning piece, which is important. Meaning wills and trusts and things like that, that people, they don't like to think about dying, and therefore they don't generally take the time to go get a will drawn up and then decide where their stuff's going to go if something is going to happen. It's probably one of the easiest yet hardest things for people to go do. And so what I tell people is just think in terms of a few basic things. If something happens to you, where do you want your stuff to go? Does it need to go to your kids? If it's going to go to your kids, are your kids old enough to inherit that money or those assets? And make sure that if they're not, or they're not in a position, that you seek the advice of an attorney to create a trust so that the assets can go to the kids or the heirs or the charity or whatever properly, and not put the kids or the heirs or the charity in a bad position. Now, the charity, not so much. They can just sell the stuff and use it for what they want. But the example I always like to use is our own situation. I have three daughters. I have a 22-year-old, an 18-year-old, and a soon-to-be 16-year-old. Now, when we created our estate plan, we basically knew that if something happened to both of us and all of the assets were to go to my three daughters, and under South Dakota law, that's where I live, is in the state of South Dakota, at age 18, it's theirs. They can do whatever they want. And I'm of the fan and of the thinking that if I'm 18 years of age and I inherited anywhere from $500,000 to $1 million, I'm going to figure out some way to make that last on the beach in Cancun for as long as I possibly can, which means I'm going to blow it at 18 years of age. So what we did is we created a trust, and it's a testamentary trust, a trust that basically comes out at the time of death, and I call them poof trusts. So you die, poof, the trust is supposed to come out. The assets go into the trust for our children, and then there are rules and stipulations as to how that money comes out for my kids. So that if each of my kids inherits $1 million, up until age 25, it's going to pay for them to go to college. It's going to pay for a car. It's going to pay for their health insurance. It's going to pay for all the things that they need to do to live. And then at 25 years of age, they're going to get a third of the trust, which then will get distributed out so that they can start to learn how to handle this. Or maybe they're going to use it to start a business, or maybe they're going to use it to buy their first house. 5 years later, there's another third that's going to come out, which is then basically half of the remainder of the trust. And then at 30 years of age, they get the remainder. Now, why did we do that? Just in case they're having trouble figuring things out and they don't screw it all up in one shot, like I would have done had I inherited money at age 18. Most people haven't taken the time to create their estate plan. Now, there's another piece that the attorneys always bring into the mix when they're doing this. It's your durable power of attorney, or your power of attorney, and your living will. Those are extremely important, because if something happens to me, I need to make sure my wife, Melissa, can step in and take care of everything that needs to happen, all the way down to selling my business. And if, in fact, I'm dead and there's no power of attorney and there's no will in place and there's nothing in place, then we have to wait for the courts to figure things out, which then my business could be decimated, which means then my family doesn't get the benefit of all the work that I've put in to have this business in place for many, many years. And I'll give you two examples of why this is so important. And, well, I don't make a penny on this. I mean, advising people to do wills, it's just an important, really important thing for people to do. There was a business that was sold in our town, that in our city of Sioux Falls, that the owner had went into an agreement, is my understanding, and I don't know if the agreement was signed or just verbal, to sell his business to somebody else. He died without a will. And it is my understanding that if that contract was not signed, which I don't know if it was or not, but the rumors were going around that the contract was not signed, that the owners, future owners, needed to wait for the state of South Dakota to settle his estate before they could buy the business. So it did not allow for that business to go where it was supposed to go. I don't know what kind of money these guys were talking about. I don't know anything about that. I just know that I heard that story. And then on top of it, I got a phone call late last week from a son of a client of mine. A client of mine fell down the stairs. He's in his upper 70s, early 80s, and he is experiencing loss of mobility and may very well have loss of mobility for the remainder of his life because of a spinal cord injury from falling down the stairs. His son had questions as to what was going on with his financial situation to determine what they needed to do next. Did he have long-term care insurance? Did he have his estate plan in place? Did he have what about the assets? Do we need to take money out of his investment accounts to pay for things down the road? Where are we at? Well, thankfully, the son, and I have copies of all of the estate planning documents, thankfully, the son is his power of attorney. So I can share information with him and help him understand his father's situation in that instance.
Yeah, no, I totally support all that. My wife and I, we finally, after years of putting it off, we finally went through a will and estate, a whole kind of session a couple of years ago, and it's not something you're going to be able to accomplish in an afternoon. You want to meet with an estate's attorney. There's like 100 things to think about, different dimensions, particularly if you own a couple properties or a business. It's you're like creating like several different trusts and so forth. There's a lot that goes into it, but it certainly feels good to get it all taken care of. And for your parents as well, any listeners who have parents, if you're just relying even on a will, what I've learned through that was, like a trust or estate, can solve things in a much better way than just a simple will. Because even if you have a simple will, it can take a long time to get adjudicated and so forth. And like the cost of that whole thing could be something like 10% of the value of the estate, just all the attorney's fees and court fees and so forth. So definitely look into it. It's definitely worth the investment, and get your parents to do the same thing with that medical power of attorney, so you can take care of your folks when something happens to them, if something happens to them. So I totally second that point of view. So Gabe, tell us again, for listeners who want to follow up with you and find out more about what you've gotten on, tell us again your book and your podcast and any websites where people can find out more about what you do.
The book is the Solopreneurs Money Manifesto. It's how to master your finances and create the life you want. Available on Amazon. Easiest, fastest way to find it. Let's see. Podcast is called Solopreneur Money. It's on all of the podcast platforms, wherever you listen to podcasts. And the websites, I'm going to give two websites that are the best places to find me. One is GabeNelsonFinancial.com. That's my registered investment advisory, my financial planning firm. There's a Start Here button there that walks you through if my philosophies align with yours and you're interested in exploring how I operate. There's a Start Here button that just kind of walks you through how I do things. And then my other is the website is called solopreneurmoney.com, and that's where you can also find my information on my book. That's where the resources that I share in my podcast are at. That's where you can listen to my podcast if you want. There's all kinds of resources there for you as well. So those are the places to find me.
Fantastic. And we will include those links in the show notes. And listeners, if you found some value in the show, a review on iTunes will help others discover the show. And you can go to umbrex.com/unleashed and sign up to get a weekly email to stay in touch with the latest episodes. Gabe, thank you so much for joining today.
Will, thank you. It's been a pleasure.